So today, we are going to look at a policy that is 7 years old. We're going to look at how it was originally set up, and then also how it has performed over the years. But what we'll also discuss are some key points that the policy owner, the individual I've worked with for the past 7 years, some key points he has raised over time, and how he views his whole life insurance policy with respect to the growth rate, meaning the actual cash value performance, and also how he plans on using it. So the first question that came up, this was during a call this past weekend, was how is the policy performing? And this is something we discuss every time we connect over a call. And my response is the net growth rate this year is right around 4.5%. And in this video, you'll actually see the growth rate, what it was year over year since day one when he started the policy all the way through year 7 and then also moving forward. But again, to answer your question, right around 4.5% is what it's growing by year over year right now. However, to set expectations properly, what I would expect over the life of the policy for anyone I'm speaking with is somewhere between that 3 to 5% growth rate. Historically, we've seen whole life insurance policies do a little bit better than that, in the 4 to 6% range, but just still being in a low interest rate environment and setting expectations more conservatively, I like that 3 to 5% range. And again, that's over the life of the policy. Because when we look at a life insurance policy in the early years, I'm negative. Now we want to minimize the expenses as much as possible, but I'm still negative. Therefore, to do 3 to 5%, I have to make up for lost time and overcome those negative years. You'll see that when we pull up his policy. But again, that 3 to 5% growth rate is specifically referring to the cash value performance, and that's with no risk. And another point he mentioned when I stated the 3 to 5% was this. He said, Steve, but I had read somewhere that if I'm doing, call it 4% in a life insurance policy, isn't that an equivalent to 7% elsewhere if I've got my money in a taxable account? And my response was, you are correct. Because when you look at a whole life insurance policy, provided we do not trigger a taxable event, such as cashing it out with a gain, or if our policy becomes a modified endowment contract, all of which is easy to prevent. But if we don't trigger a taxable event, you can access the cash value tax-free. So a lot of individuals will view their cash value as a tax-free place to position money. Therefore, if I'm earning 4% tax-free, and I'm in a 35% tax bracket, his income bracket is very high, well, that could be an equivalent to a 7% return on a taxable account. We'll pull up an example as we go through today's video. So a question that some people like to ask is, would you rather have 4% that's tax-free and no risk? Guess what that is? That's a high cash value life insurance policy, or 7% in a taxable account, and there's likely going to be some risk there over time. And most would select this. However, this question I see a lot of my peers ask, or I've seen it just in training in the industry over the years. I am personally not a fan of putting everything in life insurance. And that's how we drive our business. When you look at individuals that do very, very well with their money, what I have noticed is they're often diversified. Whether the stock market is their thing, maybe it's real estate, business, or whatever it might be. Because while this might average 7%, if you're very good at what you do with picking stocks, or maybe you have a good wealth manager that's good at picking stocks and his timing has been spot on in the past, or you're very, very good at real estate, there's going to be years where you do much better than 7%, or whatever the return is. So what we've seen is over the years, a lot of successful people have both. They're diversified in different asset classes. Now, if you want numbers, what we want to look at here is the taxable equivalent. Specifically, what I mean when I say that is if my net growth rate on a life insurance policy is 4%, and that is an effective tax-free growth rate, the taxable equivalent would show me what would I need to earn taxable to be left over with the same net of 4%. We'll look at that in a little bit. So his original plan was to move $650,000, that was the total amount, into a life insurance policy, and he wanted to do that over 5 years. That's a total of $130 per year. And the reason why, or reasons why, was A, to move cash into a safe place when he had excess funds just sitting in the bank. He still wanted access to the cash, which through the cash value, it's very easy to access. And he liked the life insurance benefit as well. His kids were younger when he started the policy, so if anything happened to him, this death benefit, which was close to $3 million, would be paid income tax-free. And at that point in time, when he was starting the policy, where he was financially and his kids being younger, that death benefit was very, very valuable to him, much more valuable then than it is now. But now the policy is moving, and you're going to see exactly how it's moving as time passes. Now, since then, 5 years have passed. He's 7 years into it. And he has decided to add not much, but a little bit of extra money into the policy. He's been paying the minimum premium because he looked at it and said, hey, I can still pay this. Does it hurt me? No, it all comes back to cash value. All right, I'll still pay it. And we look at what the performance displays with and without it. So he's done that years 6 and 7. So let's take a look here at the original policy first. So what we've got here was the illustration back from when he first started the policy. So this is an older illustration, but it does provide a breakdown as to the design, which is the most important thing. If I'm looking at this, what I want to know is where's my money going? So we've got a total here of $130,000 per year. $130,000 annually for 5 years. Over 5 years, that's $650,000. Okay, that's what he got into the policy. Where is this going? You can see it up here. Here's the premium piece. This does not build any cash value with this product the first and second year. And then this is our PUA rider. A small portion also satisfies a cost of a term rider. Adding a term rider is a cost-effective way to raise your death benefit, which prevents a MEC from occurring, which would result in taxes, and we don't want that. So he's got this premium at just about 10% of the total desired payment of $130,000. Small term rider, we can get the exact dollar amount and look at it. It was under $1,000. If I recall correctly, it was minimal, and then plowing everything else into PUAs. Okay, great. So money going into the policy, $130,000 per year. And again, this was the original illustration, which had a dividend rate of 6.7%, which has since come down. It's at 6% flat right now. So it's come down over the years, which means the actual performance will be less than what we see here. But again, we can still look at the original illustration, and his break-even point was year 5, where he's paid in $650,000, and he has more than $650,000 at that point in time. This death benefit of $2.75 million, where we came up with that number, because he did want to minimize the expenses, is that gave him a MEC limit of, look at that, just over $130,000. So when someone states, I'm interested in the policy for maximum cash value, what we'll do is design the policy with the minimum amount of life insurance needed in order to prevent that MEC, that MEC from occurring, which avoids a taxable event. If we lower that death benefit, the MEC limit would be lowered, and he would not be able to pay in the $130,000, which was how much he wanted to pay in. So in a case like this, someone has a lump sum of money, and we plan it out and decide, okay, it makes the most sense to spread this lump sum out over 5 years, $130,000 per year. So we want to solve for the minimum death benefit in order to be able to pay in $130,000 per year. If you have questions on that, let us know, and we can definitely help you out with that. So let's look at the actual performance here, and this will be fun. Here's what we've got. Here's what actually happened over the years, what's highlighted in yellow. So he's 7 years into it right now. He's already made payments for the first 7 years. First 5 years, he did everything exactly according to plan. Next 2 years, he's added a bit more. What's highlighted in yellow here represents the actual break even. So here's what actually happened. Now, on the original illustration, this was over $660,000. So why is it less here? The reason why is because the dividend has come down quite a bit. The original illustration we looked at assumed this was illustrated forever. What we're looking at on Excel is what has actually happened. We took these values from his annual statements that he receives every year and exported them to Excel. So what happened is each year the dividend came down. The past 3 years, it's been at 6%. Now with that dividend rate, that's a gross rate. I always like to mention that because a lot of times we see this and feel this is what my cash value should be growing by, which is not the case because I've got the insurance expenses that I want to factor in as well. So the internal rate of return gives me that. So what we've got here, look at that. The first year, paying 130, got almost 112, got life insurance, but I've got a negative hit of about 14%. It's the worst part of a policy, the early years. Now, second year is -2, not as bad, but it is negative. And then year 3 is the first year I get more back than what I pay in. So for example, at the end of year 2, my cash value is just about 230. I pay in 130, and I've got 365. So if this was 230 in year 2, and I add 130 to it, this would then be worth 360, but it's worth 365, $5,000 of growth, which comes out to 1.5% from a growth rate standpoint that year. So this is the annual growth rate, not the average. Check out this video for information on the average IRR. But as we look at this, here's what it's done the past 2 years. Over 4.7%, that's the net growth rate. And then the taxable equivalent, what he asked about before, so running it at a 35% tax bracket, this is displaying what he would have to earn in a taxable account to be left over with this net amount to the left. That's how that works. But that was an overview there. As far as the growth, everything below year 7 is from an in-force illustration, which is just an updated illustration we run based on the present dividend rate of 6%, so we can see what things look like moving forward. And then his last question revolved around loans and being able to use the policy. And we've got a workbook we put together which allows him to do that on his own. We always run them too, but this allows him just to get a quick on-the-fly example of what things would look like. A lot of columns there, but we walk through that with everyone we work with. So I hope you enjoyed this video. Let us know your thoughts and if you have any questions at all. And as always, I hope this helps. Thanks so much. Hey guys, Steve here with IBC Global. Thank you so much for watching the video. If you're interested in a whole life insurance policy and you'd like to work with our company in setting it up, please visit our website, ibcglobalinc.com. We would love to work with you. If you have any questions, please leave them in the comments below. And as always, I hope this helps.